for the quant fund for, the benefit of everyone. Maybe, I'll start with touching upon a bit around what quant based investing is and what does it entail and what are the key nuances of, this investing concept per se and how is it different, of course, from the traditional way of investing. So, basically, quant based investing is a systematic investing methodology which utilizes mathematical computations, statistical tools, creates detailed and algorithms basically, and put together. The job is to come to devise a model which we call a quant model, which is further able to trigger or signal lucrative investment opportunities. So, the objective of any quant based strategy is primarily to generate alpha as compared to any broader benchmark. And the entire model, any quantitative model, is devised in such a way that it utilizes or it works on a wealth of data, utilizes, like I said, mathematical computations and algorithms, statistical tools to bring together, and to utilize the financial metrics, ratios for different companies to finally build together certain signals which are investment opportunities per se. Now, as is quite evident that, quant based investing is quite data centric. It is, dependent on analysis and computation of, significantly, a wealth of data is what I can say. And hence, from that standpoint, it is more objective and empirical in nature, right? So there is little element of human bias that this investing technique has. And definitely, that is one of the clear advantages of this technique of investing, that it basically neutralizes the element of human bias, which could, lead to certain elements like greed and fear while, making decision-making process. And hence, it entails a significant amount of discipline in investment. When I say discipline in investment, of course, a traditional way of investing and where we invest in the diversified funds, which are actively managed by our fund managers, uh, they are uh, in the investments in those funds happen in such a way that they are more view based. Of course, the fund manager utilizes data, does his computations to read the data, etc. But finally, it is the view of the fund manager based on his interpretation of the data is how the investment decisions are made. At the same time, if one were to, converse with even the most eminent fund managers, money managers across the world, one of the important metric that they would want to improve upon constantly is to build a better sell discipline for themselves. When I say sell discipline, what I mean is many of them find, selling of a holding or a stock earlier than they would have, ideally done so is one of the biggest regrets for them. Basically, the art of holding on to a stock before, and not cutting the position just too soon. That's one of the regrets. Or maybe holding on to a stock and not like letting it go. So, either ways, self-discipline is a very important aspect to, manage balanced portfolio return. And in these situations, basically the impartiality, the empirical methodology that a machine uses comes in very handy, right? Because it neutralizes the human bias angle of this whole thing. At the same time, um, the quantitative, model is constructed using financial data and market trends, and hence these strategies can actually be tailor made or to suit the various investment objectives, basically, to basically suit the different investment goals per se, wherein the risk and the tolerances of the entire strategy can be modified accordingly based on the market situations, etc. So to sum up together, maybe all of it sounds a bit complicated. Like I said, that the objective of this entire way of investing is to basically devise a mathematical model which is able to read a significantly large amount of data, make sense of it based on the historical trends, based on the inputs around the various metrics or the filters that the model would have in place, and then finally to show up or to signal investment opportunities, right? So that's how that is largely the building blocks for a quant based strategy. uh, Now, why is a quant based strategy important, right? Now let's sort of peek into second. Yeah. So let's sort of, peek into, say, a cockpit, of an aircraft. As we know that the role of technology has been gaining prominence in almost all walks of life, right? If we were to take an example of an aircraft also, technology has just made flying much more safer than it was before. In fact, as we speak today, for any commercial aircraft, more than 80% of the times, the aircraft is on an autopilot mode, wherein technology and software is basically playing the larger role in flying the aircraft per se. And the role of the pilot in sort of actively engaging and maneuvering or flying the aircraft is just reduced to below 10 minutes, right? So that is the sort of equation that is used for an aircraft, right, where the role of pilot has just come down drastically over a period of time. And it's been beneficial because the rate of accidents and fatalities in aircrafts has been constantly coming down. Having said that, um, how provision of the pilot, the backup of having a pilot in case of adverse weather conditions is just uh, a non-negotiable, right? And I think many of you all would agree with the same. And that is exactly the case for the world of investment also. While the role of technology cannot be avoided, in fact, technology is something to be capitalized on, leveraged on, because it has huge merits. But it is actually the combination of man and machine when they come together that makes the killing combination per se. Now, machines are, of course, great at doing rule-based tasks in a repetitive way with a huge amount of accuracy. They can crunch a high volume of data at a great speed, and they are non-biased in nature, and hence they have a significantly, high level of discipline can be built through the use of machines, right? But at the same time, the cognitive and the creative and the judgment taking abilities of a man cannot be replaced, right? There is a whole thing around, voluntary acting that a man can do, make sense of. See, a machine relies on past data. It's able to analyze past data and hence throw up some results. It is not prepared to manage the current flow of data really and to make sense of it. That is where man comes into the picture. Whenever there are unexpected events, aberrations in the market, the active insights, the due diligence capability of the man comes into the picture, right? The qualitative decisions that need to be are very essential to be taken. That's where man comes into the picture. And hence we say that man plus machine put together is actually the ideal combination. Now let's talk a bit or delve a bit deeper into how is quant based investing done, right? So we know the traditional way of investing, wherein we look at companies, different companies, and we sort of bifurcate them under different heads or buckets, which are the sectors per se, right? That you look at the different metrics, and then you say that this belongs to a certain sector and industry, and then you look at the commonalities between the different sets, and then you assign different risk reward quotients to them, right? And you see that different sectors perform in different economic or market cycles, etc. Just an alternate lens to do the same work is factor based investing, wherein the same companies are basically bifurcated under different factor based styles, like quality, low volatility, value, momentum, growth, etc. And how are these companies bifurcated under these factor based styles? So basically, each of these factors can be analyzed through certain financial ratios or metrics per se. For example, let's pick up quality. Now, typically, quality based companies, which are typically quality companies, would have a stable earnings pattern, right? Consistency in earnings per se as compared to the rest. It would have a track record, want to see for low volatility. For growth companies, typically, companies which have higher growth prospects, which are reflected through their earnings numbers, through their high PE numbers, etc., is what comes into the growth pattern. For momentum companies, now momentum is a trend wherein basically a company which is on an upward trajectory in terms of its performance is expected to continue to be in that upward trajectory until the time there is some counterbalancing or opposing force that acts against it, right? So that's the normal elementary physics concept that we learn. The same is the concept for understanding momentum strategy, where analyzing the past, say, 6 months, 1 year price trends of a company. The idea is to pick the set of companies which are consistently growing faster than the others or giving better returns as compared to the others. So it's a backward looking price trend to sort of, pick up companies which are in rising momentum. So these are the different factor based styles, right? And it is blending these factors together along with, certain, like I said, in a certain, under a certain mathematical model using statistical tools and algorithms is a whole quantitative model that is built in. So the benefits of quant investing is that it's an emotion free investment which is unaffected by greed and fear. It has flexibility, it has repeatability, so it's rule based, which can be repeated. It can definitely build in more disciplined exits. It has enhanced transparency, right? And a better risk management capability as well. Now let's delve into our quantitative, our quant funds approach and our quantitative model per se, and what has been our investment approach basically for this fund. So the four key pillars on which we have based our quant fund is first that there needs to be a broad universe. Like I said, the objective of any quant strategy and even our quant fund is to generate alpha as compared to the broader benchmark. So there needs to be a broader index. What we've done here is we think that the experience of the active fund managers is the universe or our broader index per se. And why is it so? Because the $20 trillion mutual fund industry, equity mutual fund industry is more than $20 trillion, which is, dominated by 15 plus mutual fund houses. And there are a lot of investments that are already there, wherein the experience, the collective experience of the best of the minds of our industry, the fund managers of our industry, is getting reflected, is it's getting expressed, right? So that in itself is a very broad universe that's available for us, wherein there has been, micro lens with a micro lens. A lot of research has been done on each and every company stock. Um, and for quality and the other fundamental parameters. So we have a seasoned universe that's available for us. So that's the experience of the fund managers. Then there is the second pillar of wisdom of crowd. So from this broader base of companies, there is this element of momentum factor, which is getting expressed, in terms of their price trends. The wisdom of the crowd is getting expressed in terms of the price trends, which is reflected through the momentum factor. The third important pillar for us is the sell side revision composite, wherein basically the inputs of the sell side, the research analysts, etc., in terms of the future expectations on of the earnings, revenues, growth, etc., is a factor that is to be looked at. And fourth, last but not the least, is focus on quality, experience, and volatility. So the companies that need to be there need to necessarily exhibit these factors, these qualities of being a quality company, giving a good experience with low volatility. So these are primarily the four pillars on which our model is built. Now, what is our investment process? So, like I mentioned to you, that our broader universe is going to be, the experience of the tops 15 plus mutual fund houses in the country. And what we are looking at essentially is picking the top 75 stocks or the top 75 holdings from each of these, mutual fund houses that are under our domain per se. Why do we pick up the top 75 portion stocks only? That's because we believe that, the top 75 positions or stocks for any fund house typically accounts for more than 80% or around 80% of the holdings of that fund house per se. And that's a tested and, tested number basically, a back tested number wherein we have seen that there is at least more than 75% holding, more than 75% of the any fund houses holding is seen in their top 75 positions. In fact, it's closer to 80%. So that in itself gives us, the larger expression, the major expression of views of any of these fund houses. So we're looking finally at the top 75 stocks of the top 15 plus mutual fund houses. Of that, we are just going to weed out the small cap stocks because our universe is going to be of large and mid cap stocks. Now, see the experience of companies with the past track record of more than 5 years to look at the metrics around consistency of these companies on exhibiting this quality factor. Now, after weeding out some companies or removing some companies based on the quality factor, then we apply the momentum factor. So the momentum factor would effectively look for a test for companies which have, based on their past 6 months returns, which have delivered consistency in returns. Those are the companies that you want to pick up from here. So what are we doing here? Basically, like I told you, that we designed an investment universe for ourselves, wherein we believe that, there is significant bit of research, checks that has already gone in from the best minds of our country, the most experienced fund managers of our country who've already, done a lot of research and then, sort of built position in these stocks. So their views are expressed in them. So this is a well-researched, reasonably liquid universe that's available to us. From that, we remove the small caps because we want to retain a relatively more liquid and scalable universe, which is large and mid-cap stocks. Now, from that, we want to further check for quality, right, based on the factor quality. So we did that. Now we have a set of quality companies which are well-researched, relatively more liquid in nature. So that's what we have. On that, when we apply the momentum factor, we are then, checking for companies which are out of these, in the past, based on the past 6 months return on a rolling basis, it's been performing well, right? So they are doing well. So after doing that, What we want to check for is, okay, now we have a set of companies which have been doing well, which also, sort of tick for the quality factor. They are quality companies, but do they have the ability to continue to do well, right? So hence we go for the next factor that we look for is the sell side revision composite, wherein basically we check for the future estimates of EPS, EBITDA, growth. So it's a forward looking signal, right? Where we want to sort of further get assured about the growth prospects of this company going forward, because we are finally holding these companies for the next 3 5 years, right? So we need to be assured about that, so we go for the sell side revision composite. Once we blend that in, then finally, we have a set of companies or stocks which have been quality checked, which have been checked for performance, which have also been checked for their ability to continue to perform, right? And finally, out of these, we want to have the companies which have delivered the performance with limited volatility, with the lower volatility as compared to the rest, and hence the low volatility factor being applied. After applying that, finally we would be, having a portfolio of about 40 to 50 stock, which is what is going to be triggered by the machine and will be, sort of executed for our quant fund. Now, that was how the machine would be built and the machine would be executing. Now comes the point is, where will the autopilot mode change and where will our pilot, the fund manager, intervene in the fund management process? Of course, like I told you that, this devising the whole system, universe creation is going to be the job of the fund manager, monitoring the model, executing those signals that the machine, triggers, is all going to be the job of the fund manager. But outside that, the fund manager may intervene, uh, may take, calls outside what machine does in cases of, extreme market situation where there is a need to rebalance the portfolio, possibly a little earlier than the slated time or a little later. Sometimes he may have to, rebalance the portfolio, keeping in mind the impact cost, liquidity, equation. Sometimes, on certain companies, action needs to be taken based on, the corporate action that is there. If there is any corporate governance, even any other, unexpected regulatory change, etc., and the fund manager um, feels, that there's a need to, take certain action on a part of the portfolio, he may just do that. Other than that, it is, larger period of time based on what the model is. Now, how would this rebalancing happen, right? Because we said that, the well-defined buy and sell discipline is an important pillar or an important piece for the quant strategy to work. So after having a portfolio built, of course, during rebalancing, the model is going to show or certain signals around, based on our entire approach. Now, from the portfolio, there will be some stocks which will be doing well, and there will be some which would have possibly slowed down in terms of their performance, right? So, there is a case sort of to replace these laggards, these stocks which are showing fatigue, which are, sort of showing lower performance as compared to the ones that, the model is triggering. And hence, the bottom two quintiles of the portfolio will get replaced during rebalancing period, while the top three quintiles will continue to be a part of the portfolio. We've taken this approach basically, sort of to manage the portfolio churn and to, make the returns more efficient in nature. Now, having explained our investment approach and how the model will work, let's look at the backtesting results, the theoretical testing results, the broader benchmark. So, the benchmark for this fund per se is NSE 200, right? And on a 3 or 5 year basis, point to point basis, this the backtesting shows that the strategy, the model has generated a 9% alpha, right? And we have a 12-year backtesting record that we are presenting here to you. So, on a 12-year basis, the alpha generated is 7%. So, this is the proof of the pudding, the evidence of what our model has done. Uh, like I also mentioned a while back, that the objective also is to generate that alpha with limited volatility and, lesser churn as well. So it's important to note that the volatility of on a rolling basis, the backtesting shows that, this model was able to generate consistent alpha 94% of times on a 3-year basis and 99% times on a 5-year basis. Right? So, on a rolling basis, also, it has been able to generate alpha almost, majority of the times. So, what is important here is to understand that the time frame or the recommended time frame for investment in this fund is also more than 3 years. Some other quick facts about the fund is that, being a quant-based strategy, which is like the investment approach that I mentioned to you, it does not have any, market cap bias or sector orientation to it, and hence there's going to be an active share. That's going you will be able to see in this fund's portfolio, which means that there's going to be a deviation. There could be a reasonable deviation from the benchmark, which is going to reflect in its higher active share per se. It's going to be a large and mid cap portfolio and not have small caps. And the historical of the backtested data shows that about 45 to 50% is the exposure that's been there to, large caps, and similarly, around 50-55 to mid caps per se. Um, like I just touched upon a while back, if you compare the three strategies, which is our quant model compared to the momentum factor portfolio or the low volatility factor portfolio, you see that the volatility for our model is quite low as compared to the momentum factor. So that's an important point, and the churn per rebalance is also going to be under 30%, right? And there could be an average of less than 4 rebalances per year, right? So it would be rebalanced almost on a quarterly basis per se. So on that note, maybe I'd like to pause here and sort of take the questions that would be there.
Hi, Desha, are you there?
Just a second, I think she's facing some difficulty. Sick.
Yeah.
Disha, you there?
Yes, sir. Yeah. So the question is fairly visible on the screen. So I'll just read out for everybody's convenience. What is the market outlook for the sectors and asset classes that the Aditya Birla Sun Life Quant Fund will invest in?
Yeah, thank you so much for the question. Okay, so like I mentioned, actually there is no such orientation around sectors per se for quant fund. It is sector agnostic, market cap agnostic in nature. It could be investing in, say, like I said, the active share could be on a higher side, which also means that there could be times when the concentration could also be relatively higher, which means that at a point in time the fund could may only be invested, say, in about 3 to 4 sectors also, right? So it all depends around the triggers or the outputs that the quant model brings out, right? It's more the working of the model and not to express fundamental views per se that may be, expressed around, any particular sector per se. In terms of the market views or the market trends, that is already going to be expressed through, the various factors that the quant model is built on per se, which is already going to be, taking into account the market view and the market trends that are going on. And through that, only the signals will be sort of coming in.
Yes, thank you, Meda, for the precise answer. So, moving to next. Yeah, so what is factor investing and does it work in volatile markets?
Yeah. So factor investing, like I briefly touched upon, there are various factors of investing. Like, you can bifurcate companies based on factors like quality, momentum, growth, value, um, 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 say, sometimes, dividend as well, market cap as well. So these are the different factors based on which, you bifurcate companies. Now, these factors are based on, or the way of, assessing the factors is to assess some financial ratios or metrics which are applicable to a stock or a company, right? Now, different factors perform in different market cycles, right? At a time when the momentum factor is performing, possibly a value factor wouldn't be performing, right? Or a time when the growth factor is working, or companies of displaying the growth factor as a prominent factor are working, again, maybe the value factor may not be working. So these factors are built in such a way that, some of them have share a low or a negative correlation, while some maybe, a little faintly positively correlated. And when we devise the quant model per se, the job of the fund manager is to assess these correlations, or, the ways that these factors interplay with each other in different market environment, based on how they have shown the interplay based on different market cycles. That's how the quant model is designed per se, right? It's actually blending and building a right interplay of factors through algorithms. That's the job of the quantitative model per se. And hence, it is supposed to work in the different markets, the different cycles per se. And
Yes, thank
just
you.
to add another point, that is
Sure.
precisely also the benefit of a fund versus a factor based fund. So, today, as we speak, there are factor based investing strategy in the passive side, wherein, the passive funds are basically based on a single or maybe at most a combination of two factors. But, like I say, no factor can perform in all market cycles. There, some factors perform in a different market cycle versus the other, right? So we would have heard that, this time, quality stocks were doing well. This was a time when growth stocks were doing well. So those are nothing but factor styles playing out largely, and hence that's the precise benefit of investing in a quant fund, which is basically blending these factors in an efficient way.
Right, right. Thank you. Thank you for the precise answer once again. So, yes, moving to next. Why should we consider Aditya Birla Sun Life Quant Fund over other large cap or index funds?
Yeah. So, I think in relation to my previous response, say the approaches to a large cap fund or maybe a flexi cap fund is different as compared to a quant fund. A large cap or any other diversified fund like a flexi cap fund, and I'll come to index fund in a bit because I already touched on the passive strategies which are factor based. So the large cap and the other diversified funds are more fundamental view based funds, right? They're more traditional approaches, so which I mentioned earlier in my presentation as well, wherein the view of the fund manager is much more pronounced. So he looks at the financial metrics and data that we spoke about. So it's not that in the other strategies, the fund manager does not look at data, they look at tons of data, right? And they make sense of that data. But finally, it's the active view of that fund manager which is expressed in the portfolio. Contrary to that, in a quant based strategy, it is the model which is coming into play, and it is finally the outputs or the triggers of the model that are going to be executed, you know, at the larger portion of the time or maximum number of times. The idea is not to have the fund manager override the outputs of the model until it is absolutely necessary, right? Like we said in difficult market situations. So they are two very different ways of investing. One is more machine led, one is more man led. So that's typically so. Hence, in my view, it makes a lot of sense to, sort of allocate to both the strategies because each one has its own merits over the others. And as far as index funds are concerned, like I mentioned, of course, they have benefits like, low cost in a way, expressing, generating the returns which are delivered by the underlying index. But they also have their, limitation around being based on, say, one particular factor per se, and hence may not be, suitable for every market situation. One, then you have to invest in a whole set of index funds which are based on multiple factors. Even then I do not know how efficient it will be. So in that comparison, a quant strategy comes in very handy.
Right, right. So, yes, moving ahead. Yeah, my another question will be with limited stock universe of Aditya Birla Sun Life Quant Fund, is it going to be similar to focused or concentrated fund?